Three.
Good morning and a very warm welcome to all the property practitioners that are joining us for today's session, where we are going to be zoning in then on product risk. This is our fourth topic for the risk series. We've spoken about risk-based approach in our first session, how to conduct a risk assessment. Then we spoke about RMCPs. Friday's session was on client risk. And then today's the fourth topic on product risk. The product risk section for today is specifically for property practitioners. So you would have noticed there were a few breakaway sessions. This is actually the last of our product risk. We've already spoken to trust company and service providers, legal practitioners, and a little bit earlier this morning we spoke with the gambling sector. So for those of you who have maybe attended all the sessions, welcome again. My name is Ashley Moyer here at the FIC. I look after awareness and guidance, and I'm joined by my colleague Sibusiso Dlamini, who's going to be presenting on bulk of the presentation today on the actual product risk factors for your industry. And then, as always, we've got Karava Sachan in the background, who is assisting us with today's session to make sure that there's no glitches and the session goes ahead smoothly. So, Karava, thank you so much as always. Awesome. So as with all our other sessions, we're going to be starting off. You'll notice that there is an attendance register, or a link rather, to the attendance register that you'll find in the chat box. If you wouldn't mind, just please completing your information. It's very important for us. Not only does it give us a database for us to be able to send confirmation of attendance as well as copy of today's presentation, but we can also use it for evidence so that we can show our auditors that today's session did actually go ahead and who attended it. So please, if you could just take a quick moment to fill in that attendance register for us. Also then, as with the start of the other sessions, we do have a pre-session questionnaire, just a few questions. Again, it is anonymous. The only thing we ask from you is your industry, just so that we can be able to, slice and dice the information a little bit later when we assess it. So I'm going to maybe pause for 5 minutes. See the time on my watch now is 2 minutes past 10. So I'm just going to pause for 5 minutes. We'll start again at 7 past. If you can please click on the link and just answer those few questions for us, and then we'll be back in 5 minutes. Just for those of you that might have joined the session only now, the session has actually started. We've just taken a pause so that you can go onto the pre-session questionnaire for us. There's a few questions there, if you wouldn't mind just quickly completing, and we will be getting the session started in 3 minutes. All right, okay, so on my clock it has just turned 7 past. Thank you so much for filling in the pre-session questionnaire for us. Again, just so that you know, the purpose behind this questionnaire is for us really to have an understanding of where our industry is at. Oh, I beg your pardon, I think I've clicked a button I shouldn't have clicked. I apologize for that. Let me just quickly get the presentation back online for you. I do apologize for that. There we go. Sorry for that. That was my fault. I think I clicked the wrong thing. All right. Where was I? Yes, the information. So we're going to be using the information then really just to have an understanding of where the sectors are at, what is your level of understanding, and oh, I beg your pardon. Then at the end of our risk program, we are going to be asking for you to complete one last final questionnaire, a little bit lengthier, just so then we can gauge whether these sessions have actually been useful. Has there been a marked improvement in understanding? And that then really talks to the level of effectiveness of awareness. So we really are trying to keep ourselves accountable and make sure that these awareness sessions are useful and can actually show impact. So without further ado, I'm just going to take you through the first few slides, and then I'm going to hand over to my colleague Spoo, who's going to be taking you through the actual product factors. So we're going to be starting off just with a little bit of background again. So I know you would have attended the first 3 sessions, and in there we really spoke a lot around the FATF, the mutual evaluation findings, the different recommendations, etc. So I'm going to go rapid fire over them just to refresh your memory. I know it was a long weekend, not that long ago. So let's just refresh our memory on where we are, and then we'll pause and spend most of today on the actual product and service indicators. These are indicators that we've taken then from existing guidance, from our sector risk assessments, as well as then from international best practice. Some relevant links then that you'd find useful. The first one being Guidance Note 7. Guidance Note 7 was, we call it almost like our flagship guidance. And this was the guidance product that was issued in 2017 in October. And it, excuse me, and it really talks to the implementation of a risk-based approach. There's the FIC Act there in a soft copy. We've also provided you with a FATF risk-based approach specifically for property practitioners. And then there's the South African specific one, and this is the FIC sector risk assessment. And this was done for specifically for property practitioners. There's the link there. All of these are also available then on the FIC website directly, and then obviously the FATF guidance available on the FATF website. So to put the FATF again into context, it stands for the Financial Action Task Force. In an earlier session, I made something up and I said they are based in Switzerland, so I'm not too sure what I was thinking then, but they are based in Paris, France, and they're an international body and they set standards, and these standards are then to promote and to ensure a robust framework for anti-money laundering and counter-terrorist financing. They have come up with what is known as the 40 recommendations. South Africa is a member country. We're the only South African member to FATF, and as part of being a FATF member, we then get assessed, call it a peer review. We underwent such a review in 2019, and the results came out in 2021. The reason for the delay, I think we all know what happened between 19 and 2021 and still ongoing is what, you know, the whole COVID crisis. But anyways, the results were released in 2021. When we're talking about the ME results, and we're not going to get too hung up about this, just so that you know, the areas that really concern, well, I mean, all of them should be of major concern, but of this risk program is immediate outcome 3 that you'll see in the table at the top, which is supervision. This really is the supervisory body as well as the regulatory body being the FIX. This is really our area of concern, and this immediate outcome thematically speaks to how do we ensure that we supervise you correctly? Do we understand the industry risk properly? Yeah, how do we assess? How do we feedback? How do we guide? How do we make sure that accountable institutions are doing what they should be doing and that it's effective? Immediate outcome 4 then talks to preventative measures. Now, preventative measures, you'll find it's a combination. It's not only in terms of the FIC Act, there's also elements in POCA and POCTA-TARA. And these really talk to the controls and mitigants and obligations put in place to ensure that there's an effective anti-money laundering and counter-terrorist financing and proliferation financing framework or mechanisms in place. So your things like understanding your entity risk, understanding your client risk, identifying, assessing, mitigating, managing your risks, all your compliance obligations, etc. That all sits under preventative measures in terms of immediate outcome number 4. We were rated moderate in both of these immediate outcomes, and you would see that moderate on the scale is kind of like in the middle, so it's lukewarm. We're not good and we're also not bad, but definitely room for improvement. And then obviously the technical compliance ratings. We're not going to go into too much details, but you'll see they talk to the 40 recommendations, and there it just refers to how well did we fare in terms of these particular recommendations. And this is more from a technical compliance, so technically do we have it in place, whereas effectiveness is the immediate outcomes, and that talks to, okay, how well are we implementing it, how robust is our framework, and is it actually making a difference? I'm going to zone in on immediate outcome 4. Remember, it is the preventative measures, and this really is for the DNFBP sector as well as for FIs. So the DNFBP stands for Designated Non-Financial Businesses and Professions. DNFBPs relate to all the accountable institutions, all those institutions that need to adhere to anti-money laundering and counter-terrorist financing legislative provisions. We call them accountable institutions in South Africa, that are not banks and are not financial institutions. You guys are seen almost as the gatekeepers, so you actually bring in clients into the financial market. So what do we mean by that? So through your service and your product offering, you know, persons can purchase property, that property or the money for property then goes through into the banking system and can get paid out to whoever it is that's sold the property or renting the property, etc. So that's kind of how you're seen as a gatekeeper into the financial world. Now, the mutual evaluation under this particular IO4 honed in specifically when we're talking from a risk-based approach, and they found that the DNFBP sector as a whole, and specifically also property practitioners, was singled out as having a lack or lacking in an understanding and application of a risk-based approach. 3 things that they mentioned was the business risk assessment. So this one we really covered in quite a lot of detail in terms of topic 1, where we spoke about understand the risk from a national perspective, understand it from a sectoral perspective, and then you need to understand it as an organization. So what is the risks facing your organization? And then from there, you can take it down to a product or a client level. So that talks to client level. The new products and process risk assessment then, and this is kind of the focus of today's session, is really having an understanding of your product offering or your service offering, whether it be an existing product or a new product. What is the likelihood of this product being abused for money laundering and terrorist financing, and giving it a critical review, understanding those risks, and then understanding what controls can get implemented to mitigate and manage these risks. The last thing to mention then, just in terms of FATF recommendation 1, and this is a very important, and I know you probably get irritated because you hear us say risk a lot, but really recommendation 1, the first recommendation of the FATF recommendations, really provides the context in which to read and to apply anti-money laundering and counter-terrorist financing provisions. And that is around understanding risk, understanding it nationally, sectorally, and from an industry perspective, understanding what your risk-based approach is and applying that risk-based approach. When we talk today, so we mentioned today's session is obviously very specific for product risk. One thing that I want to remind you before I hand over to Spoo is when you're looking at your different risk factors, and he'll show you again the different risk factors, you shouldn't look at them in isolation. So in the back of your mind, when we're talking today, just remember your product risk is one of 5 risks, but collectively together it gives you an overall view of the risk both that your institution faces, because remember that's your institutional risk, and then once you've understood that, how you unpack that more granularly and understand the actual risk that your client engagements present. Now, there will definitely be an overlap. So when you hear certain instances where us talk about cash or corruption, or if you hear us talk about, politically exposed persons or high-risk jurisdictions, it's not because we're contradicting, because we know this is a product-focused discussion. But what's important is there's an overlap, because a product cannot be seen in isolation. You need to have a look at the product and how that then interacts with geographic factors or with client factors. All right, so just keep that in the back of your mind when we're going through today's presentation. So that's the end of my story. It was my job just to give you a quick refresh, and I'm going to be handing over to my colleague then, Spood Lamini. I mentioned earlier he's also part of the awareness and guidance team here at the FIC. So thank you so much, Spood. I'm going to hand over to you.
Thank you very much, Ash. Welcome, colleagues. Thank you for joining us for this morning for this session. As we mentioned, Ashley mentioned a bit earlier, we're just going to go through what we went through in the past sessions, specifically the first session that we presented to you, where we'll be looking at the risk-based approach, and we'll be just jogging your memory once again on what we discussed before we go on and take you through the product risk, which is the topic of the day. And then, well, the first thing that we looked at initially when we started these sessions was a risk management compliance program, or the RMCP, where we were looking at risk assessment and rating, as specified by Section 42(2)A of the FIC Act. What is required by Section 42(2)A of the FIC Act is that we identify, assess, monitor, mitigate, and manage the risk that the entity is exposed to. So how do you do that? You do that by looking at the provisions of the services and goods by an accountable institutions, which property practitioners are. So this may involve or facilitate money. That may involve or facilitate money laundering or terrorist financing, including proliferation financing. So on the RMCP, you need to clearly state money laundering or terrorist financing risk, and then you need to implement reasonable measures which are proportionate to the risk that you've identified. So property practitioners as accountable institutions can accurately assess the risk that they're involved in based on the risk management program or plan that they are drawing or they have in place. And this can take so that they can take an informed decision on the basis of its risk assessment that's identifying the risks that are exposed to, money laundering risks that are exposed to be specific, and the levels of verification that should be applied in a given circumstance. So, a bit later, and then we'll take you through them in the coming slides as well, where we look at product risk, geographic risk, client risk, distribution or actually channel risk. So that's what we'll be looking at. So you can't look at them in isolation. So when you do an analysis, look at your organization, look at the type of services you're providing or products that you are offering. And then that's when you'll be able to look at the risk that you could be exposed to. So we mentioned a bit earlier in the previous slides, we've mentioned these specific items: products and services risk, and delivery channel risk, geographic area risk, client type risk, and other factors. So when you're conducting your risk assessment, for example, when you're looking at your product risk, you need to know what type of products you're offering. And then are you offering those products to third-party clients? Are they are you going to receive any payments in the form of third-party payments from external clients? Are the transaction conducted in cash or EFT? Do you have any form of cross-border flow of money or transaction? Duration of the relationship between you as an entity or an accountable institution and a client? And then the next one that you're looking at is the delivery channel risk. Direct relationship. What type of relationship do we have with the clients? Is there anyone who is a mitigator, an agent, or a third party facilitating the transaction? Okay, and then is this transaction a face-to-face transaction, telephonic or social media or via email, or any form of mechanism that enables you to facilitate the transaction? Geographic area risk. Are you dealing with a client who's South African? Are you dealing with your businesses or the transaction that you're entering, transactions that you're entering into? located in South Africa, or other jurisdictions outside of South Africa. Even if they are in South Africa, what part of South Africa are those transactions taking place? Is the place that they are taking place highly susceptible to crime or less? And then client confidentiality in foreign jurisdiction. What type of legislation do they have with the clients that you are dealing with? Do they have strong or robust money laundering regulations or regulatory oversight? And then those are the things that you need to look at when you're looking at geographic area risk. Client type. What type of a client do you have? Is it a natural person, a legal person? What structure of business are you engaging in? Is it a complex structure, a simple structure? Is it a one-man show? Or you need to see what is happening. A bit later, maybe we'll highlight the risks that are associated with legal entities and beneficial ownership. So when you're dealing with a legal person, you need to understand these risks as well. Are you dealing with a politically exposed person? The prominence of the individual you're dealing with. Is he a high-profile individual, whether it's in politics, in society, in business? So those are the issues that you need to think of. Adverse information. So adverse information, you can get information in all aspects, but we'll cover them in the following slides. In some instances, you can use a simple tool such as Google to just check the client that you're dealing with, what type of information is available in public for the specific client. Negative media coverages. Are there any ML findings by supervisory bodies, whether it's a 5C, the Reserve Bank, or any other industry that or supervisory body that deals with the entity in that specific sphere? Transactional pattern. Are the transactions that you are engaged with similar or follow the structure that is linked or related to the specific type of business that you're engaged in? Other factors that you need to look at: money laundering approach, sanctions, whether the person is from the country, sanctions, or the individual, him or herself is sanctioned or related to anyone in these circles who could be sanctioned. The strategy of the entity, what strategy do they have? What are they offering? Regulatory fines in similar industries. So now let's not look at the entity alone. It's looking at the client that you have, and in their sphere or in their business, what type of regulatory fines have been imposed for a specific type of business engagement. Learnings and typologies. What do you see? It could be other client types, geographic area, or delivery channels, or products and services. What are the typologies that you see or you're learning from the transactions? Then now we are going to take you through an example of what you have to look at, maybe if you're looking at a risk metric. So for this example, we have 5 factors that we've considered, the same 5 factors that we discussed with you on the previous slides. So we just restricted these 5 factors with a score of 3 for high risk, a score of 2 for medium risk, and a score of 1 for a low risk. So the first one that we are looking at is the client type. On a client type, normally when we're dealing with an initial person, it's easier because it's the person that you are, it's a single person that you're dealing with. There's no complexity when you are dealing with an initial person, unless the risk related to that person is different from any normal, ordinary initial person in that position. You can risk rate that initial person in a certain way. But for this one, we risk rated this individual person a 1. And then on the product type, we are dealing the product that we're dealing with is a rental short-term product where we are paying with a large sum, or where there's a payment with a large sum of cash. And then the geographic area, and then the product type is rated 3, because in most instances when there's cash involved, there'll be some risk of not being able to identify maybe the source of cash or anything. So hypothetically speaking, we just rated this form of transaction a 3. The geographic area is Johannesburg CBD. Johannesburg CBD, all of us are aware that it is highly susceptible to crime of different forms. So it is a high risk area. So we'll score that area or that specific area that we're dealing with a 3. Delivery channel is a face-to-face. It's a non-face-to-face channel. So we're not seeing the person that we're dealing with. Since we're not seeing the person that we are dealing with or we're engaging with, we'll restrict that channel or the distribution platform a 3. Other factors, occupation, the person is unemployed. If he's unemployed, how is he able to pay large sums of money in cash? So the risk rating there will be a 3. The overall risk rating for all of them, when we add the 3s for other factors, delivery channel, geographic risk, product area, and client type, which give us 1, we have an overall rating of a 13. That will give us a high risk rating on our matrix. So this client is a high risk. So, but on the following slides, we'll look at how to deal with different factors as well when we have clients that are a high risk. And then the following example that we have is a legal entity. The type of product is an involved property, and then the client is paying cash again. So the client stays in Centurion. So we restricted 2 because of the complexity that is associated with legal entities. Immovable property, there's a risk if there's high risk if you purchase movable property in cash compared to purchasing movable property in a hire purchase or a bond, because there'll be verifications that should be conducted by a bank if you are purchasing on credit or hire purchase. So there'll be a lot of controls that you put in place compared to immovable property when it's paid in cash. So there'll be higher risk in that instance. The place is Centurion. We know that Centurion is a different place compared to Johannesburg City Center. So we'll risk rate Centurion a 1. This is a face-to-face interaction. So the risk there is, well, is someone you see, is someone you know, is someone you're engaging with at the face-to-face level. The risk rating will be different from a person that you don't engage with face-to-face. And then now the payment is in precious metals and stone. Or no, he deals, the client actually deals, please excuse me for this. The client deals in precious metals and stones. So precious metals and stone is a high risk area when you think from the times of black diamonds, or from the times of maybe the Zamazamas who get gold from illegal mining. So there's a lot of risk related to precious metals. Looking at all those factors, those are the things that you have to look at when you're risk rating the type of industry or the type of work or occupation that the client is engaged in. So when we add all our scores, the score that we will receive is a medium rating risk score. As we mentioned a bit earlier, this is an example, colleagues. It's not an it all, be all. You have to formulate your risk matrix based on the business that you're engaged in or the type of clients that you're dealing with. In some instances, you look at the specific transaction, and then that will give you a direction of what risk rating you should give to the specific client, product, delivery channel, or factors, which includes employment and any other thing that might come to mind for a specific business. It's an example. When I'm saying that, no, this is what you need to apply, or this one blanket covers all of it all when it comes to conducting a risk matrix. So now we are continuing, and then we're going to look at how to assess the money laundering, terrorist financing, or prohibition financing for product risk, and how to assign ratings as well. So we have an accountable institution on our left-hand side, and then we'll have an accountable institution assessment of inherent risk, and we'll be unpacking and undertaking that risk, and then we'll give a few examples. So the first risk indicator that we have, or the characteristic, which is an example as well, we have a product type which is a short-term lease agreement funded with large cash amounts. So according to FATF guidance, the trends from the guidance indicate higher susceptibility to money laundering, terrorist financing, and proliferation risk. This is subject to more abuse by criminals, and domestic trends indicate higher susceptibility to money laundering risk. And then we need to consider other commission reports that have been published in the sphere when we look at the individual that we are dealing with. So because the product type is a short-term lease agreement funded with large cash amounts, the interest rate rating, like we showed you on the previous slide, would be 3, which would be a bit higher than a normal risk of EFT transactions. The second one that we're looking at is a product type mandate to sell immovable property on behalf of a legal person. And then international and domestic trends show higher susceptibility to money laundering risk where we are not aware of who is the one body behind the transaction. So if a legal person or legal entity purchases, and then we're not even sure who's controlling that legal entity, or what is the term that's normally used is a one body behind that transaction, you tend not to see whether the individual that you're dealing with is either sanctioned or has been dealing in illicit trades, or maybe he attained his riches or money in an illegal way. So that's one, if we're not able to boil it down to the one body, we'll rate it a 3. And there's also a high susceptibility to MLTF and PF risk, which is money laundering, terrorist financing, and proliferation risk. The next one, we have a product type, which is a rental funded by a salaried person, and then he pays through EFTs. So historical trends indicate that if a person is salaried employees and then it pays through EFTs, you see that you see a certain amount going into their bank account. Then on that bank account, you see amount going out and paying for rent. So that would be a low risk, and then that's confirmed by historical trends as well, which show lower susceptibility to money laundering risk. And then the next one that we have an example for is a product type. This is a mandate to buy luxury immovable property, which is funded by cash. And then we go back to our trends again, with domestically and internationally, that show higher susceptibility to money laundering risk. This is most subject to more abuse by criminal. Domestic trends also indicate higher susceptibility to money laundering and terrorist financing risk. What you need to consider is the domestic crimes and trends and reports. Look at the reports that are produced domestically. Look at the trends of crimes that are produced that happen actually locally, and then the risk rating for you would be a 3. This is an example, colleagues. This is what you have to look at when you are looking at drafting your risk-based approach and then formulating your risk management compliance program, and how do you restrict your methodology so that it will be easier for you to mitigate and monitor the risk and put controls in place for the risk that you might be exposed to, or your entity, including your clients, might be exposing your entities to. So what sources can be used to identify and assess products or services risks? As we mentioned on the previous slides, you look at trends and typologies, and then you earlier Ashley mentioned that you can go to the FATF guidance on the factor. So that's what there are links that are attached to this presentation, and then we'll share this presentation with you a bit later. So look at what FATF guidance is available on that specific factor, and then also look at free guidance on a factor. For example, guidance note 7, which should be your Bible when it comes to a lot of things that, or obligations that are bestowed into accountable institutions. We have to look at what guidance note 7 is saying. There's also draft guidance note 7A on a specific topic. When you have time, or can you please just browse through it? That will be read with draft guidance, draft PCC 114. Another thing that you can look at is our fixed sector risk assessment. We'll just do a high level on that on the fixed sector risk assessment. Apologies for that. Sometimes when I get too excited, I stutter. So this is exciting to me because it's news that I always look at every day. So now, and the other thing that you have to look at is international and domestic trends. Also, as property practitioners, you must have knowledge of the product or a client type or geographic area that the client is coming from, or the place that you're dealing in. As we had an example of Johannesburg and Centurion on the previous slides. Also rely on open source information. For example, commission reports, media reports, as I mentioned Google earlier. But if you are a bit advanced, you can use channels like Reuters or any other publications that will allow you to make an informed decision when it comes to risk management and applying a risk-based approach. And then other considerations that you might deem feasible that maybe we did not cover in this specific presentation. So now we are going to look at other factors that maybe we're continuing actually with other factors that you must look at when you're assessing your risk. when assessing the risk of products, and then you must actually take a step back, and then you must ask yourself some of these questions. The first question that you have to ask yourself is, to what extent does the product provide anonymity to the client? We know very well we can't deal with anonymous clients, or we can't deal with someone that we do not know. We can't deal with someone that we do not know. And then, apologies, colleagues. Let me just, we have a small technical problem. Let me just try and fix it as quickly as possible, and then we go ahead. Thank you very much, colleagues. Let me just go ahead. We had a small problem there. But let me go back to what I was saying. As I was saying, that when you are dealing with your risk-based approach, we have to, it's a small technical problem. So let's just fix this quickly so that we can carry on. So the first question that you have to ask yourself, to what extent does the product you provide, or to what extent does the product provide anonymity to the client? And the other question that you can ask, does the product enable third parties who are not known to the institution to make use of it? Or does the product allow the third party payment? Is another accountable institution involved in the usage of the product? Can the product be funded with cash, or must it be funded only by way of a transfer to or from another institution? How easily and quickly can funds be converted to cash? Does the product facilitate the cross-border transfer of funds? Is the offering of the product subject to regulatory approval and or reporting? We're going to go back to these questions a bit later, but this is what you just have to sit back, colleagues, and think about when you're conducting your risk-based approach. And then when you're formulating your risk management compliance program, you have to just apply your mind to some certain extent so that you understand the risk-based approach and what it entails. So we are continuing with the questions, colleagues. The other question that you can ask yourself is, what does the product enable? What does the product enablement process entail, and how and to what extent does it include additional checks such as credit approvals, like we mentioned when you're purchasing inward property through a bank? Disclosure of information, legal agreements, licensing, regulatory approval, registration, involvement of legal professionals, etc. And then another question that you have to look at, to what extent is the usage of the product subject to parameters set by the institution, for example, value limits, duration limits, transaction limits, etc. Or to what extent is the usage of the product subject to penalties when certain conditions are not adhered to or are not met? Is the usage of the product subject to reporting to regulators or to the market? Does the historic transaction monitoring trends information indicate a lower or higher prevalence of abuse of the product for money laundering or terrorist financing? So, and then now we are looking at when assessing the risk products. These are the questions again. We're continuing with the questions that we posed on the previous slide. What is the intended target market segment for the product, for example? Entry level, the retail or high net worth individuals, because you associate different risks with the type of client that the type of client, the market, or the type of industry that you are dealing with. So if you're dealing with a high net worth client, the risk that you relate or that you link to a high net worth client is a bit different from a low net worth client. That's not a possible tool. You just have to look at the client and then apply the principles. It could be someone who's a low net worth, and then it comes to you with a transaction that is worth 1 billion. So you know that my net worth client, and then he's coming and proposing a property transaction somewhere in the coast that will include luxury homes in the, whether it's the Atlantic board or anywhere, which will amount to a huge amount of money. So you need to ask yourself those questions, and then what risks maybe are linked to such a transaction. Larger corporates are dealing with small to medium enterprise? Are you dealing to a state-owned entity or a non-profit organization? So those are issues that you need to look at. And then what type of transactions are all the entities exposed to or supposed to deal with? Specific industry or sectors or professions, there are specific professions that are related to higher risk when it comes to money laundering or service financing. And then you must upload that and look at that. And then you must know what type of businesses and industries that you're in. Are you dealing with salaried or self-employed individuals or non-employed or someone who's not working at all? So you need to know. Minor, there are regulations in all jurisdictions, even in South Africa. Minors. Some people will try and hide the process of crime by using minors. Others will be buying properties in the name of minors, trying to hide. The main reason on why they are doing such a transaction. So you need to ask yourself those questions. Is the usage of the product subject to additional scrutiny from a market abuse or consumer protection perspective? Ask yourself as well, what is the time duration of the conversion of funds, property? For example, if someone is able to buy property today, especially starting 3 months, on the 5th or 6th or 7th month, he releases the property, he sells it off, and then now he wants cash or he wants payment for the specific property. Now that's the question. If you see transactions like that, you should ask yourself, you won't go through the whole process and the whole trouble as you need property right starting 3 months and get rid of it so that you get the cash back into your pocket. And then if the product is an industry regulated product, so you must look at that as well. Does the product allow for the flow of physical cash? So cash can happen in any way. And then, as I've mentioned now, whether it's movable property or whether it's rental or any form of transaction or service that you're offering, that's what you have to look at. Equate the risk to the transaction that you're having, or the client that you're having, geographic area you're having, and other factors that you might be aware of in your industry. If someone says something else in your industry and then it doesn't link to the type of transactions that are within your space, there should be a question mark, and then you should highlight that, and then put that on a risk management compliance program. Make that tacitly put it on your risk management compliance program, and then put measures in place on how are you going to mitigate or monitor that risk if you when you identify it. And then another thing that you can look at is are there specific conditions that must be met or events that must happen for clients to have access to funds or property? Does the usage of the product entail structured transactions such as periodic payments and fixed intervals, or does it facilitate an unstructured flow of funds? What is the transaction volume facilitated by the specific product? So depending if someone is building a block of flats in, let's say, Bella, there should be a reason. And then if similar transactions happen in that space, you should know. If someone is building maybe a group of freestanding houses somewhere in Midrand, you should be aware of this environment, the space, the type of clients who purchase that, and what risks are related to such an environment. Are the products of such for short-term or long-term commercial relationships? So that's what we discussed as well on the previous points and slides. Do products require a payment from a same name account facility to facilitate the opening of a product? Some people will open different accounts and then they'll pay in different for different services and products from different accounts, so that they don't show that there's some form of money laundering happening. So it could be any form, it could be layering, it could be any form of money laundering. So it happens that some people will facilitate these forms of transaction on different ways. So it's what we should be aware of when we are conducting business. So a bit earlier we mentioned the fixed sector risk assessment on property practitioners. So we conducted a risk assessment of property practitioners. So on the next slide, we are going to highlight what was identified actually from the assessment on property practitioners. So the first item that was identified, it was that certain products and services are regarded as posing a high risk for money laundering when we're dealing with property related transactions. So some property practitioners can provide services in respect of sales and rental of different types of properties, such as residential, undeveloped land, commercial, office and retail, agricultural and industrial. And the money laundering risk associated with these different types of properties may vary considerably. So there's a difference that people will use your space, you'll use your environment for criminal activities, and then no one wants to be associated with an environment that is highly susceptible to crime. So that's what we need to be aware of. So that's what was identified by our sector risk assessment. So, and then we also identified the method of payment for property is an important criterion that can point out to the possible laundering of proceeds of crime. In some instances where bonds are not obtained to fund property transactions or large amounts that are deposited and paid in cash to property practitioners, that's what property practitioners should see some alarm bells, or should hear some alarm bells and see red lights and ask additional questions to obtain clarity on the source of their client's funding, or consider submitting suspicious and unusual transactions as accountable institution. And then what else do we look at? The deal value of property transactions. The deal value of property transaction might be an additional indication that the proceeds of crime could possibly be involved in these transactions. So the amount, for example, you need to look at what is happening when you are entering into these transactions or this business. You need to understand, for example, I made an example, if you get someone coming from Colombia and decides to buy a piece of land in the Palito area in Devon, and then he immediately wants to sell off that business. So there'd be a question mark. Why should a businessman from Colombia buy a business or a block of property or a property in Palito and wants to sell it off in a short space of time? And then he wants to pay maybe in a huge amount, foreign currency or whatever. So those are the questions that you need to ask yourself. Is it market related? Is it what the trends in international environments show at a specific time? Is what maybe trends locally in South Africa show at a specific time? So those are the questions that maybe you need to look at. That's what was identified that some property practitioners are not looking at during our sector risk assessment. And then these are the factors that are highlighted including the sector risk assessment. So we have rental agencies or property practitioners that are not aware of the purpose for which the property is required. Whether rental required and paid is market related, they don't give a hoot. Whether rental payments are made in advance, or whether they are requests for cancellation of transactions and refunds of the monies already paid. So someone will pay for a lease which is supposed to take 12 months and then pays in advance for 12 months. 3 months later, he moves out of that area and requests for a refund of the money that was paid in advance. Transaction risk, consider the use of cash in the buying and renting of properties in South Africa. And then that's what was highlighted as well, is that in South Africa, cash is still used to a large extent, which is evident by the number of cash thresholds reports that we receive as the FIC. And then in addition, the receipt of cash in their own trust accounts, estate agencies should also be aware of property practitioners. I always try to say property practitioners because that's the direction that we are moving. But this is information that was published in March 2022 before a lot of actually changes happen in our environment. So property practitioners should also be aware of instances where cash is paid into trust accounts of conveyancing attorneys in respect of transactions where they acted as an agent for the buyer, seller, or a landlord. So that's a space again that we have to look at, because it happens that that money is requested back again and recouped, and then people who are criminals and then who want to clean that money, they can use those vehicles and facilities to commit more crime. And then if you are in your space, you should be aware of them. And then these are the risks that you need to identify as well, and make sure that you put measures in place to mitigate them. And then you have controls, and then you monitor and manage such risks, depending as well on your risk tolerance and what type of clients you want to deal with or you are dealing with. Now we're going to look at FATF guidance on product risk assessment and rating. So it's a similar methodology that we discussed, but now we mentioned a bit earlier what FATF is, and then is the Financial Action Task Force. As even mentioned, that their head office is in Paris, France. So that's what we're going to look at now. Will you remember that we've been trying to communicate and then put it out there that as accountable institutions, each and every time when we're dealing with issues relating to money laundering, we need to apply the risk-based approach. And then that's what we are going to look at. And then how does FATF guide us in following that methodology? And then the first guidance that we're going to look under product risk for assessment and rating is what we have to do again. We're going to say that no, take a step back and then just think when assessing the risk products or services that you are considering, and then think of these possible risks that you might be exposed to. So the first risk that you might be exposed to is the speed of the transaction. That means the transaction that are unduly expedited without a reasonable explanation may be higher risk. So we mentioned a bit earlier that it could be any form of transaction. So if someone is hastily or hurried in a quick manner trying to make sure that the deal is finished and then everything is done quickly, and then you think twice, you need to look at what actually is the main objective or what this client is trying to achieve, and then ask yourself more questions. Type of properties that are being purchased, whether it's coastal, inland, does it make logic? Is there sense on this type of property that is being purchased? Sensitive transaction, especially of the same property in a short period of time. We made an example a bit earlier that someone buys property, such as within 3 months, gets the title deed from the register, and then once they have in 3 months, they sell it off again. And then it could be for business purposes, but if it makes sense, that it's a business transaction. If someone, for example, this shows that we like on TV these days, where people are buying properties, renovating them, and selling them out, and then making sure that they look better. If it's for business purposes, and then it makes sense that this person is dealing in property in that manner, that he renovates properties, sell them off in a short period of time. That should be low risk for you, because you'll understand that in that environment, we have to acquire a property quicker, and then we have to sell a property quicker, because it is a transaction of that nature, and then it is used for the specific purpose. And then conversion of properties into smaller units. If it makes sense as well, whether you're converting to smaller units for rental income or you're converting it into smaller units for business purposes, that makes sense. If it doesn't make sense according to the space that you are in, because as property practitioners, you are more knowledgeable compared to us as regulators when it comes to the specific product that you're dealing with. And then when you look at the product itself, you know exactly that, no, this is what happens in this environment. And then these issues might pose question when it relates to money laundering, terrorist financing, or proliferation financing. Third-party vehicles where people use trust and then to obscure the real nature of the business or the real nature of the transaction. And then under overvalued transactions, someone buys a property for way below the market value and then sells it 10 times more than the market value in a short space of time or in a long space of time. So you need to ask yourself what type or what's happening there. Is the transaction in cash? Is the transaction financed? And then what other risk might be posed by this form of transaction? Property value, not in the profile of the customer. As I mentioned a bit earlier, you get someone who is unemployed, maybe from DRC, and then walks in with a large sum of cash, buying a property, and then at a later stage sells it at a below market value. So it doesn't fit the profile of the property or the service or the customer that you're dealing with. So you need to ask yourself why or what informs this specific form of transaction. We're continuing with the FATF guidance on product risk and assessment. So the other thing that you have to look at, geographic area, location of clients and customer source of funds. So in most cases, you must look at what is happening when you see unusual sources of funds. For example, funds obtained from unknown individuals or unusual organizations, or when maybe you're looking at purchase with large amounts of cash, as we mentioned earlier, cash deposits or money orders from unusual sources or countries, as identified under country geographic risk. So country geographic risk, you remember that we made an example earlier on the local geographic risk, where we look at Centurion and Johannesburg CBD. And then we went to external parties where we took Colombia and getting an individual from Colombia buying or purchasing property in Palito. So those are the things that you look at. What do you associate with Colombia? Not everyone from Colombia is like that. It's just an example because people from Colombia some of them are associated with trafficking. So those are the questions that you need to ask. So look at the source of funds from the client, from those jurisdictions, and then understand that no, these funds were sourced in a correct manner. Use of complex loans, people borrowing money in a different way, that different accounts that they're getting money from, and they pay them in cash in some instances, and other obscure means of finance versus loans from regulated financial institutions. So those are the questions you have to look at. Unexplained changes in financial arrangements. And then as we continue with the FATF guidance on product risk, we also look at financing. Please also look at financing practices that vary between countries, and cultural differences must be recognized. To get an individual from Japan, they are a different breed of people, they do business differently. And then it's a different environment from South Africa. You get a client from South Africa, and then they are conducting a transaction. You can risk them according to what you see or what information you get when you ask more questions from the type of business they're engaging or type of risk they are posing. It's not that an individual, when he has this profile from the outlook, automatically he'll be high risk or he'll be low risk. You need to ask these questions and then apply that methodology of assessing the risk that you see from the product type, client type, geographic area, distribution channel, or other factors that will form part of this individual. So a bit earlier, I think my colleague mentioned that I think it was Ash or Yolande who mentioned that these risks, they are intertwined. So you can't look at product risk separately. You can't look at geographic risk separately. Or when you look at customer due diligence for a client, that will be what determines the risk of the transaction. Look at them holistically. Look at the risk holistically. Don't only think that one factor will determine the risk of this specific client. So that's what we need to look at every time when we are conducting this risk-based approach. And in some additional national systems, it is required or it's more common practice that other professions or businesses with customer due diligence requirements under the FATF recommendations are involved with the transactions, predominantly conveyancers, notaries, or financial institutions. This involvement of more than one profession or business might have implications regarding to customer due diligence and might reduce the risk. So in this instance, that, for example, you have a client as a property practitioner, but the client is also a legal practitioner's client. So when you are risk rating the client as a property practitioner, because the client is a client in your own right, and the legal practitioner will also do the same in his or her own right. They'll risk the client according to the risk that the client poses in the legal fraternity or legal sector. So while you as a property practitioner, you'll risk rate the client according to what risk that the client poses to the proprietary environment. It doesn't mean that, for example, if the client has already been risk rated by the legal practitioner. The practitioner should not restate the client. So that's what we have to look at when it comes to client risk or customer due diligence. That's why we said a bit earlier, these products, these external factors are intertwined and they are linked in the manner in which we need to conduct the our risk-based approach. And now we are looking at additional guidance that was given to us by FATF as well. So the next one is financing practices differ between countries as well. So now we're looking at different jurisdictions, particularly where there are those who have culture to deal with cash transactions like South Africa on a regular basis, and also those involved in obtaining or processing or closing of loan, mortgage, or financial instruments in real estate business and other designated non-financial professionals and businesses. So we need to consider these factors: the use of third parties, foreign accounts or accounts overseas, or persons or entities in other countries identified as high jurisdictions to send or receive funds on behalf of the buyer or the seller. So that's what we have to look at: a proposal from a buyer, a seller, or any other party to settle by way of visual assets. Visual assets are still at dawn, and then a lot of questions are being asked, and then we are looking at visual assets. And then I think we mentioned a bit earlier as well that we will be looking at the updated schedule items that will include visual arts as accountable institutions or people dealing in visual assets. In visual assets. As accountable institutions. Apologies for that. I'm thinking visual arts and then I'm saying visual assets. So visual arts will never be accountable institutions, or they could be, but I mean visual assets. I mean cryptocurrency visual assets, not visual arts. Visual arts is sorry for another day, is something else. So unexplained or abrupt changes in financial arrangements, use of cash in a quick sale, cash exchanges directly between seller and buyer, to include a cash deposit or a large one-off cash transaction. Multiple properties. So some people will get them that know it's very nice for all of us. Maybe some we always wish that I can have a holiday home in Cape Town, a holiday home in Miami, a holiday home in everywhere. But as property practitioners, and then if of us facilitate such transactions, there should be a reason, and then we should know exactly the profile of a client that are dealing with, and then all the other factors that we need to look at. And then now I think we're getting towards the last slides where we are looking at guidance. So the other point that we need to look at, a previously sold property is remarketed following a renovation without an obvious source of funds. All of us these days are watching those shows, and then we see it as easy as possible that you wake up in the morning, renovate a property, either stay on it or you sell it. I won't mention the shows by names, but all of us are watching those shows, think that it's something that you can do it in no time. And then there should be a reason for that. There should be a correlation between the type of activity that's happening, the risk that is related, and the end product that you get as a property practitioner. Transaction which make no obvious economic sense, particularly where there is no obvious loss. And then, where there's obvious loss. So, for example, someone purchases property, and then we mentioned that a year later, he sells the property, purchases a property for 10 rands, and then a year later sells the property for 5 rand. I know that it's a hypothetical example, but it's not the reality of what happens of what happens in property market. Investment or property management companies involved in a transaction not engaged in identifiable business activity, or a sudden an unexplained change in ownership of property without any recourse. Requests to expedite transactions, possibly over or under value, as we mentioned in the previous few line. And then part of full settlement in cash or foreign currency. Foreign currency, whether it's dollar, pound, dirham, naira, or anything. So you need to understand what's the reason for the specific transaction. If someone wants to purchase property and then settles everything quickly in foreign currency, ask yourself the questions that are related to the jurisdiction of where that money comes from. If it's a dirham, look at what the dirham is. Look at cash, which is the other factor that you have to look at. If you're looking at a dollar, look at the dollar, and then there's a factor that you have to look at. You look at the client. Is the client from the jurisdiction that they're using the currency from? If they're using naira, are they from Nigeria? If they're purchasing property in naira, if they're using a dinar, are they from a specific region that is using dinar for them to have such huge lump sum to do that specific transaction? Transaction cost or invoices of the seller or buyer paid by that party that has no connection to the transaction or thorough unusual channels. The customer requests the proceeds of a sale or rental be sent to a higher jurisdiction or third party, apparently unconnected. We understand that most South Africans moved or immigrated to other parts of the world, and then some of them still had property or still have property in South Africa. So they'll move out of South Africa, and then they leave properties for rental, for business, or anything. And then if there's a reason like that, that's understandable. But if it doesn't show any record, or someone in a foreign jurisdiction who has never been in a country receiving a large sum of money from any form of transaction happening in a country, there should be a question. Put a high risk or a risk that is relevant to the client according to the factors which are going to identify when you're looking at a specific transaction. A client asks a real estate business or a property business to hold a large sum in their client's account, and request a refund to a different banking account than that associated with the original transaction. There should be a question: what are they trying to hide? Why are they paying someone else on the different account? So those are questions you need to ask yourself. Ask the client to explain him or herself that why is this transaction happening in this sense or in this nature. And then when a property practitioner or the sector presents high risk, setup players should have specific guidelines and at their disposal as to which issues in real estate transactions are to be assessed as having a higher risk. So once you have this, you can liaise with your colleagues in your space or in your environment that according to our property, what risk do you think will pose more danger when it comes to money laundering and terrorist financing? So these guidelines are intended to ensure that the private sector players correctly assess transaction risk, that high risk issues are reported to the financial investigation unit or other competent authorities. It could be the FIC in this instance, and the legal advisors do not refrain from reporting property practitioners on the basis of professional privilege based on their own deliberations. And then, colleagues, we move along risk assessment and rating. So now we're going to look at the risk assessment and rating. And then we are going to tell you, or we're going to look at the assessment of the risk and identification of the RMCP. So the first thing that we're going to look at is identification and assessment. So property practitioners must describe in their RMCP how to assess the risk and how to identify product risk. So you as a business, we can't as a regulator come and tell you. We mentioned a bit earlier that you know your products and your clients and your environment better than us. Since you know your product, your clients and your environment better than us, we think that you are the correct person to rate or risk rate the environment, your product, the geographic area that you operate in. You need to know, and then you need to give us, when we come asking for the risk management compliance program, the ratings that you have, and then give us reasons why you have such a rating. For example, compliance assessment of all different products and scoring assigned with which is documented, and then that has to be reviewed annually as well. So give us a risk compliance program that has everything relating to money laundering risk documented, and then you need to review your risk annually. That should be ideal, but depending on the risk score that you give, it could be annually, it could be quarterly, it could be biannually. If it's high risk, it is recommended that you review your risk management compliance program and your clients quarterly, so that you check if the risk that you assigned to those high risk clients or products or area is still the same. And then it will be easier for you to manage and monitor and mitigate that specific risk as well. And then whether you have to put in additional measures, or when you're dealing with clients' risk, enhance or advance due diligence. And then when you're working on a new product or service is developed, when you receive a new service that is proposed, or a new product, or a new type of property marketing tool, or anything, or rental instrument that you want to use, you need to assess it when in terms of risk. You need to rate it. You need to put in measures in place that are required by the risk-based approach, and then specify them on your risk management compliance program. So that's what you need to have in your mind, colleagues. At all times, do not forget that when it comes to money laundering and terrorist financing, you are accountable institutions. And then, as accountable institutions, there are obligations placed on you by the Financial Intelligence Center Act, and then you must fulfill those obligations. So there's a structure that we need to follow, and then these are the guidelines we're giving to you, so that you'll be able to follow the specific structure that is required of you by the Financial Intelligence Center Act, and then you'll be able to fulfill those obligations as stipulated under Section 42(2)A of the FIC Act. And then what controls we need to look at? You need to look at processes, the systems, resources, whether it's human capital. You need to look at monitoring. You need to look at training and reporting and so forth. And these controls must be in proportionate to the risk that you identified. For example, when you're dealing with higher risk on money laundering, you need to put enhanced controls. When you deal with medium risk, you need to put additional controls. When you deal with lower risk or no risk at all, highly unlikely, but you just put simplified controls. And then risk will be adequately treated at all levels, whether it's social risk, which could be acceptable, and then that will be within the risk appetite of the property practitioner. Colleagues, thank you very much. At the moment, I think I'll hand over back to my colleague Ashley just to take us through the rest of our session today. Thank you. Over to you, Ashley.
Thank you so much, Stu. Sorry, I was hung up on one last question that came in, and I think we, while it's a hot topic question just on the issue of privilege, so I'm assuming that there might be some legal persons in today's session, as well as property practitioners. So on that particular issue, just with regards to Section 37 of the FIC Act, talks to reporting duties not being impacted or affected by confidentiality rules. And I'm reading from my booklet. So the presentation, just with reference, because I think there might have been just a slight bit of confusion, so let's just clear that up very quickly. The presentation says, and this is FATF guidance, and it refers to heightened risk. So I'm just going to read it to you. I'm not going to put it on the screen, but it says the guidelines are intended to ensure that the private sector correctly assesses transaction risk and high risk issues are reported to the FIU, which is the FIC, or other competent authorities. And this is the part then that legal advisors do not refrain from reporting on the basis of professional privilege based on their own deliberations. And I think therein lies the difference. So we definitely weren't saying that the common law principle of privilege doesn't apply. So reporting, there's no confidentiality rules from a reporting perspective. There is, however, a carve out, and that is specifically under the common law rule or common law under Section 37, subsection 2, and it's very specific instances where privilege applies, and that's obviously in the instance, and I'm going to read it to you, an attorney and attorney's client for the purpose of legal advice or litigation that is pending or commenced, and a third party and an attorney for the purposes of litigation. So the FATF guidance was saying, you can't just willy-nilly say, legal privilege, can't report. It really needs to be in the instance where the common law can actually be applied in those particular instances. So that was what the FATF guidance was getting at. All right, so I've cleared that one. Okay, so I'm going to quickly go through some of the questions then that were posted. I see not all of them are necessarily risk focus or product risk focus, but you know what, you've got us for the next 15 minutes, so it doesn't matter. I'm going to go just in the order of the most liked. So I'm just going to quickly go in the order of the most liked, and I'm going to answer those questions. So the first one then is the biggest problem is that there's no place where I can check whether the person I'm renting to is a terrorist or not. I cannot check their passports because they look right. The rentals are not so high risk that it becomes a FICA problem, usually under 25,000 a month. So in this particular instance, I just want to remind you, so this refers to a sanction screening provision. It could definitely tie in with your product risk. So if your product allows for payments from an offshore jurisdiction, or if it allows payments to a foreign politically exposed person or an FPPO, which is what we refer to it as, your product risk, there would be an overlap. In this particular instance, there are lists that you can search. So if you go onto the FIC website under international, there you would find the TFS lists. It's the targeted financial sanctions list. And then there's also a list available on the SAPS website, the South African Police Services website, or alternatively on the United Nations website. So those two lists, very quickly, they both fall under the targeted financial sanctions umbrella. And these are sanctions. So the word targeted means it's very specific and it's targeted to a specific group. And it's particular names on particular lists that have been identified by the United Nations and then gets promulgated in South Africa. Remember, we can never just copy and paste a law. We need to bring it into our legal framework. That has been done through Section 26, capital A, B, and C of the FIC Act is proliferation financing. That is the list that you'll find available on the website. The second list, which is the United Nations list or the SAPS list, which you can also find the links on our website. Those talks to, we call them the UN 1267 list. Those are the terrorist financing lists. So it would be Iran, Iraq, Al-Qaeda, Al-Shabaab. It would be those names on those particular lists. And there are search functionalities. It was one of the findings from a mutual evaluation perspective. Remember, we spoke about the different immediate outcomes. This is actually, it kind of borders an immediate outcome 3, which talks to the supervisory function. It also talks to immediate outcomes 10 and 11, which talks to terrorist financing and proliferation financing. So this currently sits, the second list sits under POCTOTARO. We're aiming to bring everything under the FIC Act so that we can provide you a one-stop shop. That should hopefully be done. I actually can't give a date because it really depends on parliamentary processes on when legislation gets approved, but it is sitting under an omnibus or on a draft update that has been circulating for comment. So we are, fingers crossed, hoping very soon that POCTOTARO will change and then that provision gets put under the FIC Act. So I can ramble on for days, but short answer, the lists are available. Please have a look on the FIC website. It is there. Please also have a look at PCC 44. PCC 44 talks about the targeted financial sanctions regime, and you can also look at guidance note 6A. So that's PCC 44 and guidance note 6A. What I will do, I'll make a note of it when we send out the confirmation of attendance and the presentation. We will then include in the slide the link to PCC 44 and guidance note 6A for the audience to read a little bit later. Okay. All monies get paid into my attorney's trust account. I get all the FICA documents, etc. myself by doing this. And this was a similar question. I think one of the property practitioners had asked us in the client risk. I don't think we actually got back to her yet. So if this is you asking the question, this is the answer to it. So in this particular instance, yes, we refer to a concept known as dual reporting. When you're an accountable institution, you're an accountable institution in respect of your transaction, so your engagement with the client. So if you are the estate agent, yes, definitely you have a customer due diligence obligation. You need to risk assess, irrelevant of whether you get money or not. That's a very important thing to consider from a property practitioner perspective. Whether you see money into your account, whether you see it into your trust account or into the conveyancing attorney's trust account, that is irrelevant from a CDD perspective. All right. It might have some considerations in terms of your product risk factor because my product doesn't receive funds. The funds actually gets given to the bank directly or gets put in a trust account of an attorney. Those are things that you can maybe consider from a product factor. When you receive funds into your account, and I think there's a Another question that talks about reporting. So if the funds comes directly into your account, which is probably very unlikely, if it comes into your trust account, yes, you have a reporting obligation. If it gets reported, I beg your pardon, if it gets deposited in cash. Likewise, if it gets deposited at a bank and it's in, so I'm going to say the blue bank. So now you have a trust account and this trust account is held at the blue bank. I go to the blue bank and I deposit cash at the blue bank. The bank and you both have a reporting obligation. Why? You are the bank's client and the person purchasing the property is your client. So there's two different legs of the transaction, where the money is coming from and where the money is ending up. And when we have a look at it, we can see the full picture. And obviously the bank wouldn't necessarily have all of that information available. Instances where you don't receive the funds and it goes directly into the trust account of an attorney, for argument's sake. So that legal practitioner would then definitely have a reporting obligation, especially if, likewise, if it got deposited into their bank account in cash over 25,000, they would have that reporting obligation. If they then pay you your commission, you know, that isn't necessarily part of this property procurement, or it's not part of that property deal. Likewise, when we say if someone receives a salary, you know, if it's in cash, then yes, it needs to be reported. But if it's going to be an EFT and it's your commission, that doesn't necessarily fit within something reportable, unless, of course, there is something untoward, something that doesn't make sense about that transaction. Why am I all of a sudden receiving, say now your commission structure was 3.5% or 4.5%, now all of a sudden you're getting paid 10%. Someone contacts you and say, oh, oops, sorry, we made a mistake. I need to, you know, can you pay this now out to a third party for me? That then becomes a suspicious transaction, okay, which probably all the bells and whistles should be going the minute you need to refund anything. Okay. So to answer the question, you're not safe by getting the documents. You're fulfilling your compliance obligation. So what you're doing is 100% correct. What steps should additional scrutiny include for high-risk clients without alerting or labeling our clients? So from a customer due diligence perspective, you know, if you've classified your client as a higher risk and you need to obtain more information, you know, there's nothing in the Act that prohibits you from, you know, requesting additional information. And again, it's within your ambit. In order to comply with the FIG Act, you need sufficient information. What you're not allowed to do is you're not allowed to tip the client off should you be submitting a suspicious transaction report. So if you get to that point in your transaction, and you now are prompted to start asking a lot more questions and you feel that that is kind of going to, you know, to tip the client off, there is a grey area, and I'm going to be honest, and this is something that was picked up in the mutual evaluation report as well. It is a fact of principle or a fact of recommendation, so really well done on picking that one up. And I say it's a grey area because the fact of principle says that in such a scenario where you actually have to request additional information or start asking a lot more questions, and this could lead to tipping off, there needs to be a decision made of submit a STR through to your FIU and then still proceed under enhanced scrutiny. But that is not in our legislation. That is not something that's permissible. We say that you need to do it. So that is a bit of a grey area for us, that we are looking at amending the legislation or also bringing in a directive that can advise you on that particular aspect. What I can tell you is, you know, don't tip the clients off, don't advise them that they are a high risk and you need this information so that you can report them one day. Steer clear of that. So unfortunately, I can't answer that question fully until we actually change the legislation. Additional scrutiny around, okay, no, we've answered that one already. If one of our clients is a PEP, Section 21 states we need to take reasonable measures to establish source of wealth and source of funds. What documents should we get from them? I'm going to refer you then to the PCC that we issued, PCC 51. I think we issued it in December or January this year, December last year, January this year. And it really does give you a lot of information around excuse me, politically exposed persons, around close known associates, what steps, what kind of questions you can ask, what kind of information you can obtain. Remember, this one is also very open. It depends again if they're saying that it depends on what they say the source of wealth is. If was it an inheritance, was it family money, you know, salary, whatever the case may be. You know, dependent on where they say it comes from, you would then be able to identify what kind of information or what documentation could verify it. Guidance Note 7 says, regardless of the instance, we always say go for information that comes from a verified or validated source. So if you want to get SARS documentation, if you want to get a court document confirming an inheritance, anything that can stand a test of validity. So obviously not like a wishy-washy piece of paper, you know what I mean, because anyone can do it. Go for a source, especially if it could be like an online source that has, you know, that is accredited and credible. That would really be the, you know, the best source of information. Please post links to guidance notes. Okay, that's what we're going to add to the presentation for you. We'll add the one on PEPs for PCC 51. We will add PCC 44, and then we'll also add guidance note 6A. I never accept cash from clients. Can there be any risk at all? Definitely. Yes, 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 yes. And it's not about the receipt of money. Remember your function we spoke about a little bit earlier. You are the gatekeepers. Literally, you open the gate for people to get into the market. I think it's such a, and I'm going to go on a tangent now, because before the session started, we were actually talking about the show on Netflix, which I'm not endorsing any show, about Ozark. And I was a little bit of a wuss because it was a bit gruesome, the first the first 1 or 2. Now I'm on episode 4 of season 1. And in there alone, they just, within 10 minutes, they explain how they launder money through purchasing a house, flipping it, overinflating construction fees, sending it out. So this money wouldn't necessarily go through the estate agent, but you know, you would be able to know, you know, with this kind of transaction makes sense. We was talking earlier about you bought it for 100, you flip it for 1 million, and then you're going to sell it again for 50 Rand. And even though the money doesn't come, and obviously dramatic examples, but the money might not come through you, but you're aware of it. And you facilitated that transaction, and you are the link with the conveyancing attorney, because, hello conveyancer, this is my client. I've gotten all the paperwork and everything ready for you. You do your risk assessment, I do my risk assessment. I don't get cash, but I know a hell of a lot about who this client is. You've engaged with them, you've taken them to houses, you've heard what they've had to say. You have an intimate knowledge around that risk. And you know, if you've got nothing else to do, watch Ozark. It's actually really interesting. Not to teach you how to launder money, but just so that you can get into the sense of how criminals actually do it and how you can be abused. So we've got 2 minutes left, so I'm going to quickly get through as many questions as I can. The minute I start seeing attendees dropping off, then we're going to end this session, but I think we've got 5 more. We've got time to go over a little bit. I'm asking my producers. They say I've got 5 minutes. 10 minutes max. Okay, so I'll be quick. If a client buys cash, but do the payment via EFT from his bank account into the account of the transferring attorney, is the client high risk only because he is rich? Sorry, I shouldn't have laughed, but no, you're not high risk because you're rich. You're high risk because you have a substantial amount of cash, and the risk lies in the sense that why do you have cash? Where does the cash come from? It's very difficult for us to validate where that cash came from. I think we were speaking about it in the earlier session with gambling this morning. Is cash it's anonymous. If someone says, where do you get it from? You can say, well, I picked it up off the floor. How am I going to prove it otherwise? So it's the cash, especially when you're purchasing a house in cash or putting a deposit down in cash. We're not talking about 20, 30,000 Rand. We're potentially talking about hundreds of thousands of Rands. And how does someone get cash? You don't just someone go to an ATM and draw out 100,000 Rand cash. Okay, so it's those elements that make it suspicious, not the fact that the person is wealthy or not. Okay, so I'm going to, these aren't posted questions, but I'm going to just quickly go through some of the questions that were asked. Must we only rate clients whom we think pose a high risk, and must we have a rating for each client that we deal with, whether low, medium or high? Definitely. Every single client that comes on board needs to go through a risk assessment, and through that process you determine whether they are high, medium or low, and based on that risk rating then you would assign the appropriate customer due diligence. So that's that one was actually quite a straightforward one. When dealing with PEPs, so politically exposed persons, here they've referred to diplomatic clients, specifically on rentals. We were told that all diplomatic clients are screened by the embassy and they don't need to complete our RMCP questionnaires. Is this accurate, and what about diplomatic immunity? Okay, so in this particular instance, we are busy with a PCC on privacy, and in this particular instance, you know, if you're going to open up a bank account, you still need to go through a customer due diligence process. There's no exemptions in the FIC Act with regards to, I mean, even politically exposed persons, foreign politically exposed persons, if you read the Act and you look at Schedule 3B, are automatically deemed a high risk. So not local PEPs. So local PEPs obviously go through the process, but with foreign PEPs, they automatically are a high risk and automatically have enhanced scrutiny. So I'm not, this is definitely not a FIC exemption or a FIC requirement. I don't mean to play the dumb card, but I have no knowledge of any exemption from a FIC Act perspective around compliance of any particular person. There's no exemptions. Okay, there might be diplomatic immunity in other respects under other legislation or other legislative requirements, which I'm not familiar with, but from a FIC Act perspective, they would still need to go through a CDD process. Clients sometimes back off from a transaction if you ask too much questions and go to estate agents who do not comply. Are these agencies audited and compliant? So that's the thing here is everyone has the same set of rules, and you know, I can't talk about people who cut corners, but those who cut corners are going to get found out eventually. With the PPRA as well as the FIC, the PPRA or the old EAB being your supervisory body, you know, they do inspections. Yeah, they perform inspections a lot, and also with the assistance of the FIC, also attending, you know, certain inspections. And part of that requirement is testing the RMCP and is testing the requirements. And, you know, they will get found out. The rules are what the rules are. When will the FIC Schedule 1 be updated to reflect the new PPA rather than the estate agency? And under the update, who will then be an accountable institution? Okay, so this is a very good question. I don't know if you guys, now I only know it because I work here, I'm not going to lie, but there is a parliamentary channel, I think it's 408 or 402 on DSTV. And also if you are on Facebook, you can, Parliament actually live streams their sessions through Facebook and on YouTube, which is something I didn't know until I Googled it last week, Wednesday. But Advocate Peter Smith from the FIC, as well as the Deputy DDG Mohammed, Ishmael Mohammed, were presenting to the House of Parliament, or I think just the level before. And in that session, they were giving an update on the schedules. It seems from that engagement, and it was an open session, I'm sure you can still go and watch it if you Google it. They had indicated that they would like to have public hearings or maybe to be provided with public consultation comments. So we're not exactly too sure how that's going to work, given that it's, you know, from a FIC Act perspective or from a FIC perspective with Treasury, we have gone through some form of consultation already. But Parliament is now on recess, so they've taken a little break. I think they're back in July or beginning August. So from there, we'd be able to pick up. So there's just a lot of context to answer your question that we don't know when the schedules are going to change. What I can say as part of those proposed schedules is the Property Practitioner Act was not around at the time where we, excuse me, had submitted the proposed schedules. So it would not fit within this round of schedule updates. We are working on a guidance product that should actually be going out for consultation very soon. We have worked with the PPRA on this. I think we've actually got a very good relationship with the PPRA. So they've given us a lot of input. We're going to be submitting it for consultation. So not to let the cat out of the bag, but the gist is, if you look at the Interpretation Act, it's an old piece of legislation that says where you have one piece of legislation that refers to another piece of legislation, and this referring legislation changes, you know, what then? And what the Interpretation Act says is you need to have a look at what the initial principle said. So in this instance, we refer to an estate agent, and I'm going to open up my book. I'm quickly going to the schedules. So it says a estate agent is defined in the Estate Agencies Effects Act. So whoever was included in that definition will remain included in that definition. Now, understand in the PPA, you guys are called something different. There's different categories. Some have been removed, some have been included. I know it refers to like bond originators. So there's a whole bunch of additional. So currently our act cannot extend. You can't scope creep. I think they call it ultra vires. You can't go over what was already implemented in our act. So that's going to be the gist of the guidance. Everyone who was deemed an estate agent in terms of the schedules now will remain included, even though you might be given a different name. So that's kind of the gist of it. No one there's no state of limbo. You do not become an AI or an accountable institution because the definition isn't updated. And just for reference, then that's the Interpretation Act. All right. Something interesting, if I see there's still lots of viewers, so I think you are keen to hear. We did issue a PCC, the number just escapes me at the moment. I think it's like 48, 49 there roundabout, which talks to the legal interpretation around legal practitioners. So if you have a look at the schedule refers to a practitioner who practices as defined in terms of the Attorneys Act. The Attorneys Act also changed to the Legal Practitioners Act. And they had a very similar question because they only used to have, some of you might also be attorneys in this session. They used to only have attorneys, and now they've brought in the concept of trust advocates. So if you're an advocate who holds trust, you can get money directly from the public, and that kind of is now part of, it's aligned with the activities of an attorney, because an attorney also receives money from the public. They both need to hold Fidelity Fund certificates in order to do so. So we're applying that same principle there. We use the Interpretation Act, and we're applying that same principle to the property practitioners space. So it's, if you want to go have a look at that PCC, I just can't remember now off the top of my head the number, but that's a similar principle that we're going to be moving across. All right. In the first session, you mentioned that you would look at creating a specific risk matrix for property. Will that still happen? So there is a draft risk matrix that's available in PCC 114. We were aiming to issue PCC 114 as a final PCC by the end of May. We had just received so much comment that we, and again, I think it's just a testament that we actually read your comments and we take it into account. And there was a lot of internal deliberation on those comments. So in there is a suggested matrix. It's a very simple matrix because this is really meant for smaller organizations, not for your large, more complex structures that have 15, 20 people that just sit in your compliance team. Okay. And then how can we check our RMCP and update it? Please look at 114. 114 is a PCC, draft PCC 114. It's going to be published very soon. It's going to probably be PCC 53. Just so you know, our drafts have different numbers and our final PCCs have final numbers, just so that people don't get confused between which document is the the latest one or not. So if you have a look at that, you would then be able to identify. We break it down into 5 core elements. We have a template that you can take into consideration. Please have a look at that. That's a very good guide for you. Unfortunately, we don't have like and we often get asked, do you have like a vetting system? Can I upload my PCC and I beg your pardon. Can I upload my RMCP and someone vet it for me? Unfortunately, we don't have that. I'm just checking for time. I'm told I can still get going a little bit. 2 minutes. 2 minutes. I'm going to take the last 2 questions, and there's still so many coming through. I'm going to take 2 more questions. If there are a couple, must both be rated. So I'm assuming that's kind of like a husband-wife scenario, or whatever scenario, a couple, 2 people purchasing a property together, definitely. I know in some instances one would probably be the main applicant and the other one would be the co-applicant, but yes, definitely both of them separately and collectively need to be considered. So definitely both of them rated, especially in the case where one person says, I want, and this is a very interesting client risk factor for your industry. If someone, and I know we're talking product, sorry, but if someone says, I really want this house, and then the other person is the one who pays and does everything, you might be a very lucky spouse and you just go around, you're like, I want that house, and then your husband or your wife or whoever pays for it. But there might be instances where it's actually untoward and it doesn't make sense why there's a third person now paying for your property. They weren't involved, you've never met them, you've got no idea. And if your product does allow for that, then that might be a heightened risk, and collectively you would have then been able to determine if there's a higher risk or not. Okay, so the last question, because I'm being given this now, I need to end, is street gambling money needs to be declared as well. So I'm not quite too sure. I don't know if street gambling is legal. I know normal gambling is legal because it's it's done by an accredited organization. They need to go through a licensing process through their provincial or the national licensing authority. So should that activity be illegal and it's unlicensed and you're not allowed to perform it, then that actually becomes a proceed of a crime because it's an illegal activity. And sorry, I don't know if street gambling is illegal or not, so I can't really answer that question with much conviction. But if it is illegal, then yes, definitely it is a proceed of crime. If you become aware that someone is purchasing or giving you a deposit based off of an illegal activity, or there's a suspicion, then definitely that definitely increases the risk, and it's definitely going to be something that you have to report through to the FIC. All right, so I really need to leave it there. Thank you so much for joining us, and there were so many of you that stayed on for the extra Q&A. I think that's really awesome to see. We are going to be catching up with you again on Thursday and Friday. We are definitely going to enjoy the break tomorrow just to recoup, maybe go through all the questions and see if there's anything that we might have missed that we can then include in the upcoming sessions. So all the best for the rest of the day. Keep well, God bless, and we'll see you then on Thursday. Cheers all.